Hello and Happy New Year. This is Brian Shannon from Alpha Trends Blogspot. Today is Wednesday, the 2nd of January, 2008, and the market's closed here. Our first session was a down one, unless you were in solar stocks, I think, or unless you were short, or if you were short solar stocks, I guess you had a down day too, and we'll talk about those in a minute. But starting with the S&P 500, we see that the spiders lost $1.50, or just over 1%, came down and tested this low right here of 143.96 that we saw December 18th, that is. And that's really a pretty important level, I think, because we've got this lower high here, and now if we make another lower low, it puts these other larger numbers into jeopardy as well. And potentially this market is tracing out a larger top. Shorter term on the daily time frame, I think it's more neutral. You can't really get all that bearish on it yet until we break these August and certainly at least the November lows. Doing that, I think, would be really be bad for a lot of people's confidence in this market. And today we saw some of the larger stocks selling off as well. No damage really done to Google or to Baidu or Apple or any of those stocks, but we did see selling in there, and that might just be some people who were selling the stocks because they wanted to wait until this year before locking in some of the large gains that people have accumulated. That way they defer the taxes for a year and they don't have that tax obligation due till till 2009. So the S&P 500 did experience some selling. We do see a declining 50-day moving average that did cross down through the 200-day moving average here as well, and that gets a lot of people's attention. So that's something, again, to be concerned about. The bigger levels of support are going to be found again on the weekly time frame. But what we've been seeing here on the 10-minute time frame is that this market, since it made this lower low right here, has been making a pattern of lower highs and lower lows. Last video we were looking for the potential of some support based off of Fibonacci, but again, Fibonacci is just one little piece of a complicated puzzle, and the only thing that pays is price. That's where the majority of your analysis needs to, the weighting of your analysis needs to be given the most attention. The prior levels of support that we were looking at were this 147 level, which is obviously broken very severely here today, with the market testing these lows again from late December. And so far, again, the bulls aren't starting out to a good year. But as we know, anything can happen. I hope you saw that chart that I posted on my blog the other day, just kind of outlining some of these huge rallies and declines we saw last year. More than 15 of them that were greater than the overall market movement for the entire year. So that's something you have to keep aware remember that basically the bigger picture here on the daily time frame is just really choppy, and that's why you're going to make your money being focused on the trends that occur and that unfold over the course of a week and 2 weeks at a time. Those are the most important levels. We were looking for potential support, but I had also said that the evidence isn't there for a purchase. Don't get involved on the long side yet. It's not time to be looking for that. And the inverted head and shoulders pattern that we've been looking at really, like I said, needed to clear this 152 level. Now we've got the lower high near 150. That's going to be the important level going forward here over the next couple of weeks. If somehow the market gets back above that level, then perhaps it can recover. But it's really just not starting out to look to be like a good year for stocks. And the thing that amazes me is that that people have been talking about. I listen to the background a little bit, CNBC once in a while, and it seems like all the analysts that come on there are talking about how they expect the Russell 2000 and the small to mid-cap stocks to be the leaders this year. These stocks led for years here, from all the way from 2003. These stocks had a 4-year rally where they led this market higher. Now this trend line has been broken for the last couple months. Trend line breaks don't signal a reversal, but they are one of the most important early warnings that a reversal may be coming. Then when we combine that with these lower highs, and now it looks like another lower high at a very important level too, near this $80 level, where we have again, that 200-day moving average, and we've seen this prior selling. So last week we saw that 80 level act as resistance once again for the IWM, and the more times that support is tested down near the $73 level, the resolve of the buyers weakens, and it becomes almost inevitable that you see a breakdown. I don't think you want to look for it right now in the very short term. The breakdowns usually don't come after a decline that's this severe. However, that's what doesn't happen most of the time. Be aware that it could still break down from there, and maybe breaking down from there will get people's attention, and enough that that we could kind of clear the deck, have people really just throw their positions away below that $73 level. And then if it could quickly recover, that's about as bullish scenario as I can see right now. And that's all theoretical. Right now, what you have to focus on is price action. We have clearly a level where sellers reside up near $80. We've had buyers down near 73, 73.5. Whether or not they find the reason to buy there on the next test, we'll see. But in here, again, last week we got defensive as, again, the pattern of this higher highs and higher lows was broken right here, and now it's been guilty till proven innocent with this pattern of lower highs and lower lows. Now the market did show some signs of stabilizing at these lower levels, but that doesn't mean it's time to buy. It means that for a swing trader, you should have been focusing on the short side in here for the overall general market. But again, there's always going to be stocks that are moving counter to the trend of the overall market. And if you prefer longs only, then the stock that I'd mentioned last week last Friday in the video was Hoku. I said keep an eye on that. Today I'd mentioned it again on my blog this morning, saying that it looks like the stock might begin to move. And Hoku is a polysilicon supplier. So all these they're kind of like the Cisco to the solar industry. They supply this, what they need to make it work. And here, if you look at the longer term chart, this thing could get going pretty ridiculously to the upside. I've been trading in and out of it, which is why I don't like to give specific advice. But it's been a good stock, and it looks like it should continue to. Maybe tomorrow above this 1260 level is where the buyers come back into it. Let's take a look at the semiconductors, because this market, group got hit hard again today, down 2.7%. And the semiconductors have been leading this market lower. This is not a good sign for the overall broad market. Like I said, it looked like maybe it was trying to stabilize in here, but that's not a reason to buy just because it looks to have found support. These consolidations in a downtrend tend to resolve themselves in the direction of the primary trend, which is clearly lower in these semiconductors. And again, maybe we're headed for a test of this larger level near 380. So it's possible the market's heading down towards 380. That's still another 16 points to go. There's no reason to step in front of this freight train and try and buy the stocks, because it's just not supporting any bullish cause in here, obviously. If we look at the NASDAQ 100, the Qs also had a bad day, down 0.77 or 77 cents rather, or $1.50. And we saw that this 5250 level, and this is going to be important for several months, I think. It looks like this market is locked in this range of 48.5 to 52.5, and until it breaks that, it's going to be just a back and forth choppy market, it looks like. Now the short term is clearly lower. Maybe it's going to try and find some support near 50, but as long as this 5-day moving average is declining, consider it guilty till proven innocent. There was no reason to try and buy in front of this type of movement, especially when you see. Also, I don't talk about it. It's rare that I talk about the Dow, but the Dow did break this December 18th low here. So if you look at that, as far as maybe that's going to lead the S&P 500, if we put, that could put the S&P 500 here to put it in a very similar scenario to where the Dow is. So there's a lot of bad signs out there. Now, the first couple days of the new year in any market, a lot of times there's a lot of volatility as people do make a lot of decisions based on taxes and various allocations for their year. So continue to just be on high alert for opportunities in either direction, and that'll do it till tomorrow.